Today, I want to share with you the only 7-step financial plan that most Indians will ever need. Drawing on my 20 years of experience in financial services, I found that simple, straightforward financial planning is the most effective approach. These 7 timeless rules have helped 95% of Indian households not just achieve financial stability but also build lasting wealth. I'm Shivaputra MC, and I'm excited to guide you through this proven plan. One of the most important financial steps you can take is to build a contingency fund for emergencies. Surprisingly, only 27% of Indian households have enough savings to cover 3 or more months of expenses. This lack of financial cushion can make unexpected events like job loss or medical emergencies extremely destabilizing. To protect yourself, aim to set aside between 12 to 18 months worth of your monthly expenses. It's crucial to keep this money in safe, easily accessible places, such as liquid mutual funds, fixed deposits, or ultra-short-term debt funds. These options ensure that your funds are secure and can be redeemed quickly, usually within 1 to 2 working days, so you're ready for whatever life throws your way. Let's talk about life insurance, specifically term plans, and the situation in India. Did you know that over 75% of Indians are either underinsured or have the wrong type of insurance? This is a huge concern because it means many families might not be adequately protected financially. The key to proper coverage is choosing the right amount. For term life insurance, a good rule of thumb is to have coverage that is 7 to 10 times your annual income. This ensures that in the event of an unfortunate incident, your family can maintain their financial stability. Another important point is to consider splitting your coverage between 2 different insurers. This strategy adds an extra layer of security, protecting you in case one insurer faces issues. By diversifying your policies, you reduce risk and improve your overall protection. Health insurance is absolutely essential for protecting your family. Did you know that over 60% of medical expenses in India are paid out of pocket? That means a sudden medical emergency can easily drain years of your hard-earned savings. To avoid this financial strain, it's wise to opt for a family floater health insurance policy. Ideally, you should look for coverage between 50 lakhs to 1 crore rupees. Also, pay attention to features like cashless hospitalization, which allows you to receive treatment without upfront payments, and restoration benefits that recharge your sum insured if it gets exhausted. These options provide comprehensive protection and peace of mind for your entire family. When it comes to building long-term wealth, it's important to dedicate a significant portion of your income, around 15 to 25%, towards investments that can grow over time. Mutual funds and equities are key options here. Despite their potential, only about 7.5% of Indian households currently invest in these avenues. Many people keep their savings in places that barely outpace inflation, which means their money isn't really growing in real terms. To change that, consider allocating part of your salary to long-term investment options like equity mutual funds, the Public Provident Fund, or the National Pension System. These instruments not only offer better returns over the long haul but also help secure your financial future. When managing loans smartly, it's important to keep your monthly installments within certain limits to maintain financial stability. For a home loan, your EMI or equated monthly installment should ideally not exceed 30 to 35% of your monthly income. For example, if you earn 100,000 rupees a month, your home loan EMI should be no more than 35,000 rupees. Similarly, for a car loan, the recommended limit is lower, between 10 to 15% of your monthly income. So, if your income is 100,000 rupees, your car loan EMI should stay at or below 15,000 rupees. By keeping your EMIs within these ranges, you ensure that you have enough flexibility in your budget to cover other expenses and savings, preventing financial strain. Credit cards can be incredibly useful financial tools, but they can also become a trap if not managed carefully. For instance, 1 in every 4 Indian credit card users ends up revolving their credit, which means they only pay a part of their bill each month and carry the remaining balance forward. This comes with a steep cost, as the interest rates on revolving credit can range from 30 to 40%, quickly adding up and making debts harder to pay off. To avoid falling into this trap, it's crucial to use credit cards with discipline. A good rule of thumb is to never spend more than 1 to 1.5 months' salary on your card. This helps keep your spending in check and manageable. Equally important is to always pay your full credit card bill every month to avoid interest charges. Lastly, be cautious about converting your credit card dues into EMIs. This option should only be considered in emergencies, as it can lead to longer-term debt and additional interest costs. By following these guidelines, you can harness the power of credit cards without letting them control your finances. Let's wrap up with your 7-step checklist for financial well-being. First, building an emergency fund is crucial. Aim to save 12 to 18 months' worth of expenses to cover unexpected situations. Next, securing term life insurance with coverage between 7 to 10 times your annual income protects your loved ones financially. Health insurance is equally important. A family floater plan ranging from 50 lakh to 1 crore rupees can provide comprehensive coverage. For your investments, consider allocating 15 to 20% of your income for long-term growth. When managing loans, keep your home EMI under 35% and car EMI below 15% of your income to maintain financial stability. Use credit smartly by limiting your spending and paying off balances in full each month to avoid interest. Lastly, accept that unpredictability is part of life. Review your finances annually to stay prepared. Remember what Warren Buffett said, "Do not save what is left after spending, but spend what is left after saving." Start today, and your future self will thank you. Let me tell you about Shivaputra MC, a highly experienced financial services professional with over 19 years in the industry. Shivaputra is an AMFI-Registered mutual fund distributor, dedicated to helping Indian families build, protect, and maintain their long-term wealth through tailored and disciplined investment strategies. Throughout his career, Shivaputra has held leadership positions in some of the most respected financial institutions, including ASQI, Scient Capital, Carvey Capital, Sundaram Mutual Fund, Principal Financial Group, and ICICI Securities. This wide-ranging experience has given him strong expertise in portfolio management, investment strategy development, structured finance, and client relationship management. Moreover, his solid academic credentials, including an MBA in Finance and Marketing from Alliance Business Academy, a Bachelor of Commerce in Advanced Accounting from Vijaya College, and certifications as an Associate Financial Planner and AMFI Certified Mutual Fund Distributor, complement his real-world expertise. This combination of knowledge and practical experience makes Shivaputra a trusted advisor for families looking to secure their financial future. As we wrap up, remember that successful financial planning doesn't require complicated strategies or risky shortcuts. Instead, focus on these 7 timeless rules we've discussed, and make sure to work with a trusted advisor who truly understands your individual goals and circumstances. Warren Buffett wisely said, "Do not save what is left after spending, but spend what is left after saving." That mindset alone can change your financial future. So start today. Taking that first step now will make a big difference, and your future self will thank you for it. Thank you for your time, and if you have any questions or want to connect, feel free to reach out via email, phone, or LinkedIn.